Hi, everyone. This is Rob Roy, and welcome to the LA Wave Options U.S. Market Update. As we do each and every week, we show you on your screen the stocks that will be featured in this recording. As a quick reminder, if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. All right, let's take a look at the chart of the markets. Just a quick reminder, we are recording this during market hours, towards the end of the market trading day on Friday, but things could change slightly into the close, and I know it's not ideal, but travel and time commitments, sometimes we have to do it just a little bit early. But we've had a big bounce back rally from yesterday's bloodbath. Big reversal day yesterday where we opened higher, reversed back to the downside, closed on the lows of the day. And I told our subscribers during an insiders meeting last night that when we close on the day on high volume, and you can see from the volume underlay here, big spike up in volume yesterday. Oftentimes you get a reversal the next day. That's what's occurring so far. It does look like it'll hold into the close, and we're holding, importantly, the 650 level. We broke through 660 like nothing. That was support resistance going back all the way to September, October. We broke to the new highs. We satisfied that zigzag. If you've watched the previous recordings, you have evidence of all these. We showed the zigzag ahead of time, came back down. And I said, if we don't hold 660, we need to hold 650. If we break 650, then it gets really dicey to the downside. But look what's been going on in the market. So we had the big run up, then we had chop for a couple months, then we broke higher, and now we've had a bit of a downtrending market. So we've covered all three of the primary markets over the last few months: up, down, sideways. And one of the things that I wanted to bring to your attention is a free event that I'm doing Monday. So it's Monday evening at 8 p.m. called AI Fusion, where we talk about how you can use AI to inject in these three different markets. And we have a portfolio called Level 3, which combines all three of the market conditions: sideways, up or down directionally, and then strangles, which are done on triangles that can break either direction. Since we started using AI, here's a chart on your screen of what this system has returned since the beginning of 2022. What you need to know is that even though we're using a starting portfolio of $10,000, we don't put more than $500 of risk in any trade. So you honestly could do this with a $5,000 account. Now you can see, started out of the box on the downside, had some good months. You can see there's a couple spikes there, really good months, had some down months. Nothing works 100% of the time. But what you most need to know is where's your portfolio now compared to when you started. And if you started back in the beginning of 2022 and where we are now at the end of 2025, you can see by the yellow line, what started as a $10,000 account would now be worth $40,000. That's been the returns since the beginning, and these are not compounded results. I think that's really important. So if you want to learn how professional traders utilize different market conditions, and now we have AI being infused in all different strategies, you can sign up for it. Again, it's free. If you can't make the event live on Monday, no problem. You get the recording. Love to have you live, though, because then you get an opportunity to ask questions during the live Q&A. So please sign up for that AI infusion. Look forward to having you there Monday night. Before I go on, I'm also going to be giving an outlook for the end of this year and the beginning of next year. I did the same thing this year. If you can look at this chart here, you can see in the middle of March, I was talking about in a downtrend where things could likely go. And I hand drew those, not very well, but I hand drew the zigzag lines on there. So that was what I was expecting: the B wave to go up back towards 575, and then that C wave to extend down towards 500. You may want to know, how did that play out? Well, take a look at what actually happened after I gave that forecast. Look at the B wave right at 575 and the C wave down below 500. The only thing I got wrong was it actually happened just a slight bit early, about 2 weeks earlier than what I had forecast. So that was a spot-on forecast that I created back earlier this year. So if you want to see what I'm thinking things are going to go through the end of the year and the beginning of next year, another reason to join that event on Monday night at 8 p.m. Eastern time. So love to have you there. That was pretty darn accurate. I think you would agree. All right, let's get back to the charts now. We'll take a look at a chart of the VIX, looking at heightened volatility. Warned about this in the last couple of recordings. This big downtrend line is the weekly chart of the VIX. And then also the fact that we've been building this higher low here on the VIX, it really felt like we were going to have an upside breakout. We had a triangle here. You never know. Triangles trump everything, and triangles can break either direction. You could have leaned towards the upside with the higher lows, and it did indeed break to the upside on the volatility. And we got right there to where we were on the tariff tantrum 2 low in the markets, with the VIX going up above 27, coming down a little bit. But even at the time of this recording, we're above 23 on the VIX. So we're still above this upper trend line. The thing that would be concerning is that was resistance for a while, 22.5. We've been trading between 15 and 22.5 for the better part of the entire year. And now we've broken above that. Is that going to become support? Can you imagine 22.5 on the VIX being support? That means there's a lot more downside to come. Hopefully that doesn't play out. But if it does, then what we go back to with the SPY chart and look at this breakdown, if we break 650, I said, oh, then it gets real dicey. Another thing to note here that I meant to mention before is we now have, or at least the software, and I want to make sure I'm clear on this, these are not my labels. I don't label this. These are automated labels from the actual algorithm that Ralph Nelson Elliott himself wrote. The Hub software, HUBB.com, does this. If you want to get a copy before Monday, you can go to HUBB.com. If you don't have it already, get it for free. The LA Wave signals are free. You do have an opportunity to subscribe to the AI signals if you want, but you don't have to. The software is free, and the LA Wave is free. But that wave 4 is green, which means it's still active. So the algorithm is not convinced that this wave 4 is going to hold. It didn't even quite make it to the 23.6% fib level, so that's a little concerning. We do have a little bit of support here, but we don't have as much support at 650 as we had at 660, so things are still a little bit dicey. What helped play into the rally today, I think, was the New York Fed governor came out and said, hey, we're ready to cut. It's only one voting member, so he doesn't speak for everybody. And all the Fed governors, you know, they all like their 15 minutes of airtime. It seems like they all come out with their opinions. Chairman Powell has seemed to be quite hawkish lately. We did get the government non-farm payrolls report that came out, and that was for the month of September. We're not going to get the October report, and we're not going to get November until after the Fed meeting. Some were even opining, will the Fed postpone their meeting in December? I don't think that's going to happen. But the surprising news was that the September payrolls report was higher than expected, actually twice what was expected. 50,000 jobs were expected to be added. They added over 100,000, but they did revise down both August and July to lower numbers. But none of the private sector reports, the ADP Challenger reports that were still coming out even during the government shutdown, showed the kind of numbers that the non-farm payrolls from the government did. So that kind of put a little bit of concern yesterday into the fact that, maybe we don't get that December rate cut, and that could derail the expected Santa Claus rally or the end of the year rally that normally happens this time of year. But the bottom line here is 650 needs to hold on the SPY. Otherwise, we could be down here at 630 and have a bigger corrective move. Even if Elliott were here himself, he'd say, oh, you know, the 23.6% level is a fib level, and so I put it in the algorithm, but he doesn't have a whole lot of trust in it. But could that Fed governor's report kind of change things a little bit? At least it has for this Friday. We'll see moving forward. We are going to start to get into a seasonally lower volume time of year. Market tends to rise up. The old expression, never short a dull market. Maybe we can hold 650 here and continue to rally. Let's go to the bond market and see what's going on with TLT, starting on the 20-year. In the bond market, this is what's been really interesting to me, is just like, it's like a sleep at the switch. Nothing is happening in the bond market. We've just been going sideways. We did follow the triangle rules. That's part of the AI infusion event. That's one of the portfolios in level 3 that I was mentioning, break out to triangles. And the bond market, as you know, if you've been watching, has done nothing but form triangles all year. The only directional moves in the bond market have been the breakouts of the triangles, and then you go right into another consolidation. Right now, we're consolidating more in a channel than a triangle, but we broke to the upside out of the triangle. We came back to the point of the triangle and tested it. Those are triangle rules. And now we've been going dead sideways. slightly elevated on the interest rates, but not significantly so. You can see on the TLT, this is prices as a reminder. Prices and yields move inversely. So as prices come down, yields and rates are going up. But it hasn't been a big sprint to the upside, which you might expect. We look at TNX on the 10-year, you see the opposite, because on the TNX, it reflects rates, actually rates, where TLT is prices. So there's the tick up in rates. But again, nothing really that significant, and we're still flat across the yield curve. That's what's been going on, is that even though rates have ticked up, we don't have a steepening yield curve. We know the economy is still weak. We know the jobs market, except for the non-farm payrolls, is showing weakness. We'll get some inflationary data before the Fed meeting. What's the Fed going to do? Is a toss of a coin at this point in time, at least based on the Fed fund futures, is what's going to happen. But if I go back to the chart of the SPY, and you see this move down. I've been talking to you about this for a while, and those same data scientists that create the AI signals for Hub create these liquidity charts for us. And I showed you this last week in a couple of weeks, but look at this Fed liquidity chart that shows what's been going on. Look at that drop in liquidity. And I had mentioned before that as the Fed continues to withdraw liquidity, now they've told us they're going to wrap that up around the beginning of December. And there was another Fed governor that came out and said, hey, we're ready to inject liquidity. So again, we've got opposing Chairman Powell on the comments. But one thing I want to draw your attention to on this liquidity chart is, look, the last time we had a withdrawal of liquidity, look at that date. That's 2023. And it didn't wrap up. It had that spike bottom right before the January of 2025. So basically for 2 years, we slowly moved on this withdrawal liquidity, but not this time. This time it's just been a vacuum down on the withdrawal liquidity from the Fed. It all happened within a couple of months, and very difficult for markets to go higher when you're seeing that kind of a drop. Look at the divergence between where the S&P is and liquidity. Now you know why the market's been dropping like this, and we've had these big, ugly days. Now, you may have also noticed that some international markets have actually been performing pretty well. India, Brazil, some other ones. And that's because if we look at the next chart, global liquidity has been better. So when you look at the blue line here, global liquidity, there's better liquidity around the globe than there is in the U.S. Now, if I told you about this a couple weeks ago, that we probably have a couple more weeks of this, but if we believe what the Fed says, wink, wink, because who knows, they flip-flop around. That's been my criticism, is they say one thing one week and another thing the next. Chairman Powell did it, where he intimated that they were done with their balance sheet reduction at a press conference or a interview that he was doing a couple weeks ago. And then the next week they had the FOMC meeting. He said, no, we're not done yet till the beginning of December. Complete different rhetoric, from my opinion. But that's the reason, going back to the liquidity chart here, the fact that global liquidity has been better than the U.S., and that's why you've seen some international markets moving better, and some money is rotated there, in fairness. All right, now let's go and get back to the charts. We'll take a look at the chart of the S&P. So when we look at the the dollar, take a look at the dollar, and we're getting a little bit of a tick up. Surprising a little bit, because interest rates haven't really been moving that much higher. Liquidity's been coming out. Rates haven't been moving that much higher, but we are getting a little bit of a bid in the dollar. It's not significant, so don't worry about it too much. I told you about this the last 2 weeks, that we've had these two zigzags in the dollar, and it did look like we were going to break above 100. We have. And so which of these two zigzags will hold? Maybe the highest one at 101 does. And if we get that high for the extension level on the second zigzag, we're awfully close to that previous four. The wave 5 ended less than 100% extension. That means you retrace back to the wave 4. That's Elliott wave rules. So we could move a little bit higher. Pardon me. I think that's okay. You've heard me say that I didn't want to see the dollar collapse down. Because I thought countries would start to maybe question whether they want to hold U.S. dollars and take those big losses. So we managed to get back into what I've called the Goldilocks channel here. That's an ideal scenario for the dollar. It keeps the dollar on the lower end, helps exchange rates, but we don't want to see the dollar go high either. So now you can see where I came up with a Goldilocks channel here. We don't want it to go too high. We don't want it to go too low, just right. So we want it to stay right in here. But I do think we can withstand a move back to the previous four. And the reason I say that is if the dollar goes too high, you're going to hear that in the next quarterly earnings reports where companies, if they don't make their numbers, it's going to be a convenient excuse. Oh, well, we would have made our numbers, but the exchange rate hurt us. And without that, we would have been okay. I don't know that just moving back up near 102 is enough to do that, but it could give some companies an excuse because the dollar is a bit higher than where it was. But if the Fed does come through with a December rate cut, who knows if they will, but it does feel like at some point in time, we're going to get a rate cut if it's not December in the beginning of next year, because regardless of whether the non-farm payroll number shows it or not, you hear it on the financial networks, companies laying off people left and right. Some of it is because of business. Some of it's because of AI. It doesn't really matter what the reason is. The jobs market has weakened significantly. And unless we see some really hot inflationary data between now and the December Fed meeting, maybe the Fed meeting does cut that 25 basis points. And if they start injecting liquidity, then we could maybe start an end of the year rally. But without that, if they don't wrap up their liquidity withdrawal and they don't cut rates, that 650 level could really come into play here on the S&P. Now let's look at some of the other markets. Look at the Dow. A lot of these are going to look similar. The DIA performed a little bit better. So far, it's holding its first level here of support at 460. We are below the 10-day moving average, testing the 50-day moving average today. Can that hold? That doesn't really matter. We do need to get back above, and you can see the convergence of the 10, 30, and 50-day moving averages here. We need to get back above 470 is what we need on the DIA. But first things first, 460 has to hold. Then we start bouncing back up, which we're trying to do today. Can we follow that through on Monday? If you watch my recordings, you know how much weight I put in and follow through a confirmation day. The market loves to give head fakes, loves to fake out the retail trader. That's why you need that follow through or confirmation day. But even getting back above the 10-day moving average, resistance at 470 is so close. We got to break above that. Then maybe we can breathe a little bit of a sigh of relief. We'll have to see. When we go to the Qs, take a look at the Qs here and a move down here to this previous B. I warned about this if you watched last week's recording, that if we didn't hold up here around the 610 level on the Qs, then based on zigzag rules, if that C wave ends, it retraces the B wave, and we could come back down here to 590. It's exactly what happened. The C wave obviously was over, and we moved back down, broke below the 50-day moving average here. We do have a bearish cross on the 1030, so I think we have to be careful with this rally today. We need to see follow through at the beginning of next week, and maybe that Thanksgiving holiday coming in helps on lower volume, and we can get a little bit of a drift back to the upside. But some of these charts are really in danger of being significantly damaged. For now, hanging on by our fingernails. The analogy I use of fingernails hanging on the edge of a cliff. We are just still a little bit below the 10-day moving average, so maybe a little bit more room here. You saw the big reversal in NVIDIA. We'll talk about that when we get to the chart of NVIDIA and stocks of interest. Let's go to the IWM now. Taking a look there. This is in no man's land here. And it isn't because of rates. I've talked so often about how the IWM is the most rate sensitive of all markets. Small caps, they need to borrow money. So if rates tick up, they tend not to borrow, but they need to borrow so they can grow and expand their business. So as the bond market moves, oftentimes so does the IWM. But correlations don't always exist. And the IWM is not only correlated to interest rates, it's also a view of risk tolerance in the market. There's small caps, higher beta names, oftentimes. A little bit more risk there. What's the risk appetite in the market itself? The IWM gives a good idea of that. And so since we've had this move down without really a significant increase in rates, I showed you the charts of the TNX and TLT, they're just kind of consolidating, and yet we've been going straight down here on the IWM. That shows you it's the risk side of things. The market is a little sketchy on taking risk at this moment. We'll see how it plays out. The next level to watch is 225 here on the IWM. We had a little bit of an oversold bounce today, closing on the lows yesterday like a lot of the markets did. So we're getting all those bounces, but it doesn't mean anything yet. If you're watching the IWM and you want to get in, you got a ways to go. it's got to get back here above 245. In my opinion, it would be prudent to wait, even though we could bounce up that. It just oftentimes I give an aggressive or a conservative view because we all have different risk tolerances. You have to work within your own, or you'll have an ulcer in the world of trading. But getting back above 245, I think, just makes sense, whether you're aggressive or conservative in those markets. Now let's look at metals, and we take a look at gold. A little bit of a bid in gold today, but not much. As you can see, so far, even though it hasn't felt like the metals market has been performing very well, so far it's really just been a pretty needed consolidation here. We had this big, massive run. Nothing can go straight up forever. And consolidating without any sort of more significant downward move, I think is actually healthy in the gold market. And you can see I'm redrawing these lines because really what we have is another triangle. I've talked about this a lot in the past. GLD loves to do this. Form triangles, break out, form triangles, and break out. Talk about that Monday night as well in the triangle section. Had a couple comments of people that said, oh, wow, I like your information on triangles. It's really helped my trading. You don't have to pick a direction when you're looking at triangles. You just have to cover both sides. But the bottom line here is with everything going on, liquidity, interest rates, etc., the metals market has really held in pretty well. I think we could be setting ourselves up if we get the Fed injecting liquidity. And I think that's more important on whether or not the Fed cuts rates in December. I'm not really tied to whether they cut in December or not. I do feel if they don't cut in December, it'll be sometime in the beginning of the year. But what I'm more interested in, liquidity drives markets. I don't think anybody can argue that. And you saw the liquidity chart. That has to reverse, or the markets are in for more downside. But silver, very similar chart here. Instead of a symmetrical triangle, I think you could make an argument here this is more of a descending triangle. But remember that descending triangles do not guarantee a downside breakout. Any triangle can break either direction. And then now let's move into, holy cow, crypto space. Talk about a bloodbath, but we called this too. We were pretty accurate on this. If you go back and watch previous recordings, if you haven't seen them, I did mention that if we didn't hold 60, we're probably going to go down to 55. And if we couldn't hold 55, which we tried for about a week, then it would be likely a pretty quick move down to 45. And the reason for that is condense the chart. Let's go back and look at what happened in April. See how fast that moved up from 45 to 55? So there was no resistance in the way. So if we broke below 55, at least on the BITB, one of the ETFs that tracks Bitcoin, then we were likely going to quickly come down to 45. And that's exactly what's happened. This is the line in the sand. We're back at the tariff tantrum lows of April on Bitcoin. Can this hold? You would think this would be a logical place. So even though we're well below the 10-day moving average, even though it looks like trying to catch a falling knife, if you are aggressive minded, maybe this is where you could step in and take a shot on the BITB for Bitcoin. If it breaks 45, that's your support level. You're immediately out. So from a risk to reward standpoint, not a lot of risk for a potential bounce. But as far as this rally into the end of the year on cryptos that a lot of people were calling for earlier, there's a lot of constructive work that needs to be done in crypto land, and they need that liquidity to come back in for that to happen. So now 55 will act as resistance, but we could get a snapback rally somewhere between 45 and 55. And then Ethereum, we got this one pretty well also. The scenario here was mentioned if we couldn't hold 25, same thing back in July, vertical move up from 20 to 25, no resistance on the way down. It tried to hold 25, couldn't do it. Quick move down to 20. There was just a vacuum in the crypto space between these support levels. And if they were broken, you get a flush out move down. And that's what happened. So now you can see there was pretty good support here from May, June, and July at the 20 level on Ethereum. And we look at the ETHW, again, crypto ETF. In this case, it's an Ethereum ETF. Can the ETHW hold 20? Same scenario I just talked about with BITB. If you're really aggressive, you could maybe step in and see if you get a snapback up towards the 25 level, which will act as resistance. But holy cow, we break 20, Now we're down here. That's the next level of support. If we can't hold the 20 level, it's pretty solid. So that's why I think, again, from a risk to reward standpoint, if you were looking to take advantage of this crypto collapse that we've had, if you want to call it that, over the last couple of weeks, maybe this is an ideal scenario to get in. Let's go to energy, UNG. I was finally right on this. Way off on the timing, but finally right. I thought we would hit 15. That line of resistance at 15 has been on the charts for weeks, as you know, because way back here in September, I thought we might make a run up to 15, but we needed to base for a while. We had such a big downward move, selling the rips all the way down. And at some point, I felt like the sellers would get exhausted and we would run back up to 15. We finally did that. So this is nice consolidation. I'm watching UNG very closely. This is what I called for. Talked about this during the live shows this week for our subscribers at evotrader.com. If we could consolidate under 15 and then break above it, we might have a pretty good run up here to 17 and a half. I'm not saying that natural gas is off and running and a big move to the upside. I'm not saying that at all. I'm just saying there could be a tradable move to the upside if we can break above 15 with follow through. And the ideal setup to try to break it is consolidating under 15, not breaking it on this big run up from 12 and a half. If you go straight up and you break a resistance level, it tends not to hold. You want this consolidation, then break it, build some momentum and energy, then break it. Those tend to hold more. So we'll see how that plays out. Then oil breaking down. We do have a strangle. We had one back here on this other triangle. We have another one in our portfolio on the smaller triangle. So we won't hang around this one too long, but there's the breakdown out of the triangle. And then it brings in to mind a break to the downside in oil. It just makes me wonder, how long will OPEC allow the price of oil to go down before they announce a production cut? So a decrease in production obviously would put a bid back under oil. I don't know. I'm not in the boardroom of OPEC. 65 seems like a logical spot. We didn't wait for it on the last breakout. We closed out down here. Got the timing pretty spot on there as well, even though I did feel like 65 was support, but we had profit, and so we took it, and now we're in the same boat again. A nervous break to the downside. I do think 65 is safe. But if we were to break 65, I think you would quickly hear OPEC announce some sort of a production cut. All right, now let's move into some stocks of interest. And before we get there, I did want to show you a chart of IBB. This is something that I mentioned on Trade Finder this week as a place that you could go to hide. And if you're wondering what's Trade Finder, each and every week on Tuesday at 1 p.m. Eastern Time, do a show called Trade Finder. It's a live show during market hours. So 1 p.m. Eastern Time on Tuesdays. Look at the markets, look for trade ideas. This was the trade idea that I gave out for those of you that watched it. The IBB, the biotech, you can see we've had a pretty nice move up here. It's also a defensive sector. So when the market's not doing well, you can move higher in a defensive-minded sector. So that's worked out really well since Tuesday. So if you haven't joined Trade Finder, if you haven't been part of it, sign up on that link. You can go to the website at evotrader.com and sign up for Trade Finder there as well. Love to have you. Have a great community there. They ask a lot of great questions. So there is a live Q&A and there's a chat so you can interact with each other. Great social media aspect to it as well. So going back to stocks of interest, obviously we have to talk NVIDIA. That was all the news yesterday where they absolutely smashed their earnings. No doubt about it. Crushed earnings. Couldn't have been more glowing on their guidance moving forward. We opened higher. I hated the gap on the open. And I was like, oh, man, I wish we wouldn't have gapped up like that. And look, the gap open was the high of the day. And then the reversal occurred yesterday, and we closed on the low of the day. That's not the kind of bar that you want to see. And certainly, if what NVIDIA said couldn't hold a bid there, that shows you something else is going on. And I do believe it's liquidity. We have a lack of liquidity in the market, and even a great earnings report with great guidance couldn't hold. You can have a great earnings report and poor guidance, and the stock goes down, but they nailed both of them. We are holding a very important level here at 175. I mentioned that yesterday to our subscribers that this was the next level. There's a lot of congestion through the 175 level on NVIDIA going back to July. So if we can hold that, maybe we can bounce, but we got to get back above 185 first. So anything between 175 and 185 is really meaningless. Doesn't mean anything until we get it back above 185. There's the 10 and the 50-day moving averages merging together. Look what happens if the market really rolls over, the Fed doesn't start putting liquidity back in, we don't get the rate cut, and we start to get another big leg down in the markets. Boy, there is nothing to hold NVIDIA from 175 down to 150. That would be your risk. So it's really important that NVIDIA holds this 175 level. Looking at Apple was in the news. They're starting to look at their succession plans from Tim Cook. If you've heard me, you know that I'm cheering that. I'm not really a big Apple fan. I don't use their products, but I've been frustrated. And if I was a big Mac head Apple fan, I would have been very frustrated. Tim Cook's reign, he's been more of a manager of the accounts, etc., but not an innovator. And the person that they have tapped in line does have a reputation of an innovator, someone I think that Steve Jobs would approve of taking over. And maybe at some point, Apple actually goes back to innovation. That would be cool, wouldn't it? But it's not a stock I like to short. Even I can complain about their business model, the fact that they haven't innovated anything new. They're resting on their laurels of the iPhone and the products they've already had, but they've got a ton of money and they can do stock buybacks at any time, which makes it perilous to short the stock. So I don't really short Apple, but I haven't been long it either. This is a really strong consolidation right here in the 270 level. So watch for that. Maybe it takes to the beginning of December when things change liquidity wise. But if we can break above this little corridor here around 272 with follow through, Apple could easily run up to that 300 level. It would get into the tractor beam effect. So if you like to be long Apple, keep an eye on that. But that's been a stalwart, really, in the selling that's occurred. And I think it is because they have so much money. And then AMD. AMD, I've warned earlier in the week, I actually talked about this during Trade Finder on Tuesday. And I said, remember the chart of Oracle? They had that big gap up and it filled the gap. I said, this is in play. If we can't hold the 50-day moving average, it's in play that we might fill this gap, and we're headed down there. Now, we are at a fib level at 38.2 on the wave 4. That may hold. It's in no man's land, though. You can see support was at 225. We broke below that. That brought filling the gap into play. But maybe this 38.2% fib level holds and we can start to bounce. We are a little bit oversold from the 10-day moving average. So once again, if you're very aggressive minded and you were looking for something, maybe you could take a shot on AMD. But if it breaks the low of today, then you're out because it likely is coming down to 175 at that point in time. But if you wanted to see, hey, we're oversold, separated from the 10-day moving average, remember, no security in any time frame gets very far from the 10-day moving average, at least not for long. You could get a little bit of a bounce back. Not saying that AMD is ready to go off and running. It's going to have resistance at 225. When I talk about these oversold bounces or overbought moves to the downside, the separation from the 10-day moving average trade is a 1 to 3 day trade. That's it. Not looking for big significant moves. It's a quick in and out type of thing, but you can see these opportunities when you get the separation from where the trading stock is and the 10-day moving average, the underlying and the 10-day moving average. Palantir, this is at a point that's quite interesting now. They had great earnings and great guidance. Still, the stock sold off. Their problem is their multiple is so high. The valuation is extreme. It's in the stratosphere, really. But we've corrected some of that. And we're back into an area here. It was resistance back in June. It acted as support in July, support in August, support in September. Then we formed this triangle. We broke out of the triangle, went too vertical, too far, too fast. We've come back down. We've corrected all that stuff. And if 150 can hold, maybe you can start thinking about going long Palantir again. If it breaks 150, well, then we're coming down to 125. That would be next. But another one, can this support level hold? Where's the follow through at the beginning of the week? We need to see that. But at least now you can start to maybe think we're in a point where we could get a bit of a bid back into Palantir. Tesla, we talked about the Elon pay package thing. That didn't really seem to affect it. This is a real technical chart here. You can see the wave 3, which is key because of these two support levels here, this channel that we've been trading in between 400 and 450 for quite some time on Tesla. I mentioned that if we could break 450, probably head up to that big round number. If we can't hold 450, we're probably coming down to 400. And that's what ended up happening. Now, the key here is 400 needs to hold. See what remember I've been talking about these vertical moves that are getting retraced. It was pretty vertical coming out of this ascending triangle from 350 to 400. There is no resistance on the way down from 400 to 350. So it's really important that Tesla holds 400. If it does, maybe it makes another run back to 450. It's got to get it back above the 10 and 50-day moving averages first. And there's going to be a lot of resistance at 450 from this area here of resistance in September, October, and even early November. So again, this is just maybe a quick reflex bounce from 400. But to get excited about going long Tesla again, you got to see a break above 450. That's the prudent thing. Amazon, we're moving into what you would think is a seasonally good time, big retail time. Lots of arguments on what the health of the retail consumer is going to be. Some early numbers, Gap, for one, has shown that the consumer is still willing to spend. You never can count out the U.S. consumer. With the jobs market, we've seen that there's been a rise in credit card defaults, auto loan defaults. The middle to lower income part of the economy is certainly feeling the pain. But boy, no matter how bad things look, the U.S. consumer finds a way to spend. And we'll see if that can put a bid back into Amazon here. I think any move down, I've been saying this for quite some time. I'm a big fan of the stock of Amazon as a long-term play. Something that I think, they're doing everything right, in my opinion. And for the long term is a great place to be. And when you get these pullbacks, they're buying opportunities. It would be more ideal to see 210 if we could get back here. The wave 5 ended just under 100%, so it should move back down towards this 210. If you could see Amazon at 210, I think that's a great buying opportunity. We are a little bit oversold here, so we could get a little bit of a reflex bounce at the beginning of the week. And we still have to dodge this liquidity thing, at least if we believe what the Fed says, until the beginning of December. So we could get a little bit lower move. Doesn't have to be too much more. But 210 would be, I think, an ideal entry point. And then you guys asked for it. I read your comments. Please leave a comment under this video. Hit subscribe. I appreciate it very much. We do a giveaway. Not going to show you the slide because of the extension of this video here, but we do a giveaway every month for our level 3. You'll see all about that Monday night if you come to the AI Infusion event. But you ask about this, I read all of your comments. I answer as many as I can, time and travel permitted. But boy, back to that catching a falling knife scenario. That's where we are on CRWV. 100 needed to hold. Last time I talked about this, and said that it needed to hold. There was support in this area here from August, September. You break below it. Look at it. There's nothing after this scenario right here, right in this area. There's nothing to hold it. It's probably coming down to 50 in that area. I just don't see anything that holds it. It's not that far from the 10-day moving average either. Thanks for your attention as always. Everybody have a great Thanksgiving holiday weekend. Look forward to talking to you soon. Hopefully Monday night. Take care, everybody.